Hi everybody, my name is Janine. I'm with Dave Barnett with Attract Capital.
Hello everyone.
We're here doing the monthly webinar series, and today we're going to be talking about why mezzanine debt is a good option for acquisition funding. So Dave.
Hey Janine, how are you?
I'm good, how are you?
I'm doing great. This is a very exciting topic because it's somewhat of a distillation of having been in the mezzanine world for about 28 years. So I'm excited.
That's a long time, 28 years.
I know, it is a long time.
That means he knows what he's doing.
I feel old at times because I've been doing it that long, but I'm committed to the mezzanine world.
That's good. So how long have you been doing these mezzanine deals, and how many deals have you done?
Well, I'd say I've probably done about 150 middle market size deals. And I'd say if you added them all up, from the first deal to the most recent deal, we've probably done $1 billion, $1.2 billion in total value of loan size. So we've been doing middle market deals for a really long time, having started in the mezzanine middle market in the early 1990s. So maybe before you were born, Janine.
Yeah, 1991, so.
It was a very good year.
Yes, it was. I think so. So how do you think these deals have worked out for your clients?
So these mezzanine deals, I think, have worked out fantastic for my clients because my clients tend to be business owners who have built successful businesses or entrepreneurs that want to buy businesses, but they don't have a lot of their own money to put into the acquisition of the company. They might have a good bit of money, but they may not have 25 or 30% of the total purchase price. So what mezzanine allows them to do is it gives them that hard to raise capital so that they can fund the entire purchase price. And so I've had clients that have had small businesses and have done a series of acquisitions using the value in the business. They've been able to fund all the money they needed to buy the company through mezzanine, and it's really functioned as a form of like investment or equity investment for them. And it's been an incredibly valuable way to build a company. And a lot of them have sold their companies and done quite well when they've sold.
Oh wow, so there's a lot of benefit that comes to doing this sort of transaction.
Absolutely, and the huge benefit, and that's the perfect word, the huge benefit to this, Janine, is that when you raise mezzanine into your company, you don't give up your shares and you don't get diluted by an investor. You pay a higher interest rate than you would from a bank, but you basically get all the money you need to close your deal, and it's a very powerful tool as you're trying to scale your business.
Wow, that's really good information to know. And some of the major strengths with mezzanine debt, what would you say they are?
So I will compare it to a bank loan, and then I'll compare it to an equity investor. So the strengths compared to a bank loan is that you're going to get a much bigger check because mezzanine lenders do not look at your assets when they structure the size of the loan. They look at your income, they look at your EBITDA, and they will typically give you a multiple of your EBITDA ranging from 3 to 4 times. Sometimes it can be as high as 5 times. So it's really based on income. So companies that are asset poor but EBITDA and cash flow rich can do very well with the mezzanine loan and get a very big check, whereas they won't get any really decent sized check from a bank. You also, relative to a bank, you'll get a longer time period to repay it, and you don't have to pay back the principal right away. So the term is going to be longer, and it's much more relaxed in terms of paying back the loan. Everybody likes a relaxed repayment schedule when the bank isn't knocking at the door and saying, please pay me back right away. Typically, with mezzanine loans, you get 2 or 3 years where you're only paying interest, which is a very powerful thing because you can keep all the cash in the business. So it's flexible, it has a longer term, you don't have to pay back as much principal, and you get a bigger check than you would from a bank. Compared to an equity investor, it's much less expensive because, as I touched on earlier, an equity investor, if they're going to come and they're going to help you buy another company, they'll typically say, well, we'll give you $1 million or $2 million of equity, but we're going to want to own 30 or 40% of the company. So if you bring in a mezzanine lender, you don't have to give away the ownership.
Oh, that's good to know.
So it's a very powerful arbitrage. It's a very good trade. If you can use mezzanine in lieu of the equity investor, you don't have to give up all those shares, which all my clients, they've worked really hard to get to the business to the size it is. The last thing they want to do is give up shares and ownership in the business to raise the money. So it's very powerful, and it has a lot of benefits compared to the bank, and it's very powerful and has many benefits compared to an equity investor.
So do you feel like this is then more of a one-stop sort of source?
There you go,
Yeah.
Janine. Absolutely, it's like a one-stop shop. And one of the most powerful benefits too of a mezzanine loan is that typically when you get a bank loan, the bank wants a personal guarantee, and a personal guarantee is always something that when you sign your name on the dotted line of a personal guarantee, it means that you're on the hook to the bank for the amount of that loan. Mezzanine loans don't require a personal guarantee. So when I usually tell that to somebody and they find out that a mezzanine lender doesn't require a PG, they get very excited.
So why wouldn't you take that option?
I mean, it's like, even if it's more expensive, it's like, I'm not on the hook, right?
Exactly.
Give me the money and I'm not on the hook. So back to your great question. They are a one-stop source of capital. And what that means is that you can go to a mezzanine lender and say, Mr. Mezzanine Lender, I need $10 million because I want to buy this company. They will say, they'll look at it, they'll make sure that the numbers work, they'll make sure that you have enough EBITDA, they'll make sure that it's a very solid company, that you're buying at the right price, and they'll give you all the money. Instead of going to a bank for maybe a third of it, and then going to a mezzanine lender for a third of it, and then going to an investor for a third of it, where you might have three people or three different companies you have to go to get the funding. A mezzanine lender, if it fits and if they believe in the growth, because a lot of what a mezzanine lender is doing is they're funding based on the future growth of the company. So they have to believe that it's a good company, that it has really strong management, and that the company can grow and hit its future projections. If they don't believe all that, it makes it a much tougher deal to close. But if they do, what they're doing is giving you this money so that you can grow the company, and when the company's bigger, you can pay it back. As opposed to a bank who will give you the money and say you have to pay it back every year over the next 3 or 4 years. So it's much more flexible and it's much safer to grow with a mezzanine lender.
And it seems supportive too.
That's a great point. That's a great point, Janine. They have your back. They are very patient, and the reason they're patient is because they really try to understand the business and get into the minds and the psychology of the people that are running the business so that they are aligned. One of the big themes with mezzanine lenders is they want to have alignment. Mm-hmm. They want to be completely lockstep with the growth vision that the management team has. So, because they have to be patient. If you really think about it, if you're making a loan that is, let's say you're making a $5 million loan or a $6 million loan, and the company has $2 million of cash flow and it has $1 million of assets, the only way you're going to get your loan repaid is if that cash flow continues and grows. If it doesn't sustain itself and if it doesn't grow, you're probably not going to get your loan back. So you're kind of forced to be very selective and you're forced to be patient.
Okay, so selective. And I'm sure there's a lot of candidates out there. So who would be the best to work with in this situation?
Absolutely. And so unfortunately, this type of financing is available to companies that have reached a certain size. And those companies tend to be first the types of companies: technology companies, service companies, healthcare companies, manufacturing, distribution companies, all qualified. They generally are asset light, but cash flow rich companies. They usually have revenue starting at $15 to $20 million. And generally they have EBITDA of $2 million and up. And the amount of the capital that they're looking for in the loan size is usually a minimum of $5 million. So if you have about a $20 million revenue business doing $2 million of EBITDA, and you need a minimum of $5 million of financing, and you're in the United States and Canada or in the UK, and increasingly in other parts of Europe, then you're a good candidate for it.
Okay, and then do you find is this more expensive than being with the bank?
It is. No, it's a really good point, Janine. It is more expensive. So a lot of people say, wow, this is 10% money. I can get money from the bank for 6%. Yeah, you can get money from the bank for 6%. But you can get let's say you can get $1 million from the bank, but you can get $5 million from the mezzanine lender. So if they're going to give you an extra $4 million, that has a lot of value because really what they're doing, mezzanine is a transitional source of financing that funds the hard to fill gap for your company. If the gap is because of an acquisition or if the gap is because you want to grow faster, they're going to fill that gap. And because they go deeper and they fill that gap, they charge you more because they're taking more risk. But it is absolutely worth it to pay that extra interest because you're getting more. Like if you get a bank loan, you can do some things with a bank loan, but you can't do all that you want. It's about having the right amount of money when you need it to pursue your growth dream.
Seems like something that's very valuable, I would think.
Yeah, I agree. It is. I mean, we've been doing it for 28 years. The mezzanine industry has been growing very rapidly, and it continues to grow. It's not easy to get this money. It's not something that you just get an application and fill out your name and submit it online to the bank, and they tell you you've been accepted. It's a very it's an intense process where the lender's trying to learn about your business. But if you're looking to get involved in the mezzanine world and you're looking to get a loan that will allow you to take advantage of acquisition funding, you should definitely go to our website at attractcapital.com. We've got about 150 articles on our blog, and we've got a lot of good information there about structure, criteria, do's and don'ts, and that sort of thing.
And that was going to be my last question, the criteria. What does that look like to get involved with this?
Yeah, so the criteria would be, I'd say, to keep it simple, like 20 million in revenue, 2 million in EBITDA, and you have a $5 million capital need at a minimum. But usually 5 to 20 million of capital need is sort of the sweet spot for middle market mezzanine lenders.
All right, sweet spot. I like how that sounds. So there you go. You can go to attractcapital.com, find out some more information, contact Dave directly, and for anything else, we're always here.
Thank you so much, Janine. Thank you for watching. Take care. We'll see you next month.